Brian, you and I have known each other for 25 years. What is it that you actually really do?
Good question, John. Really, the role of the institutional trader is to facilitate buying and selling of equities on behalf of institutional clients, which could be mutual funds, pension funds, hedge funds, and even high net worth individuals.
And do you invest money for the bank on the bank's behalf as well?
Wouldn't call it investing, John. What it is we do use some of the bank's capital to help facilitate our client or order business. If a client was looking to buy a certain equity and we didn't have as much of it for sale that they wanted to do, we may actually help facilitate it by shorting them that stock and then, of course, covering the short at a later point in time.
Brian, the vast majority of investors are not professionals, and so I think getting a glimpse behind the scenes, sort of a peek behind the curtain, so to speak, is really interesting for people. So, can you give us a sense of sort of your day-to-day? Like, what's a day, an average day like for you?
Sure. Average day would start probably around 6:30. Traders would assemble on the desk as well as salespeople, and typically we'd have a morning meeting. Right now, they're all being done on Microsoft Teams, which is great. But we review any sort of pertinent news that may affect the markets, what's happened overnight in the overnight equities in Asia and in Europe. And then also if there have been any changes to, of our analysts' opinion on any of the companies that they cover. They may upgrade it, downgrade it, there may be earnings out. Review those, return to our desk, and every trader would have a list of clients, institutional clients that they would call, and pass that information or some of the feedback back to those traders who are working at these institutions.
Brian, what kind of strategies do you see? It's been crazy for the last 4 or 5 months. It's been crazy in the past, and I know you've done billion-dollar trades. What kind of strategies do you need to employ? And then, as a follow-up question to that, what kind of strategies are your clients employing to try to manage and mitigate the risks that they're dealing with in these really crazy times?
I think, Johnny, risk is probably the biggest thing that people are focusing on managing, both on a capital side and on an exposure side, both but at the bank and at the institutions. So I think in those volatile markets, which we've seen, the biggest thing is mitigating any risk to the bank or to investors. And that's where the institutions were focused on.
And just to follow up on that, this markets have recovered really, really nicely from the March lows. What kind of activities do you see large pools of capital doing? Are they all in, or are they sort of saying this? We're seeing the green shoots here, or how are they looking at things?
John, for some of the institutions, the drop happened so quickly that it didn't give them an opportunity to react. And for others, it was an opportunity that maybe they were going to deploy capital to other sectors or take maybe money out of the equity market to put it somewhere else, maybe in fixed income or cash. And we did see that. But there were a lot of accounts that, because the move was so quick, actually didn't do a lot of selling or buying.
And Brian, when you are trading, how much of it depends on what the client's requesting you to do, and how much of it is you recommending you probably want to do this?
In the recommendation side, it is all about best execution. So how are we going to get the institution the best price for their buy or for their sell? And that's where I would consider where a trader would take his or her expertise and guide the client to what, in that moment of time, where you're going to find best execution.
And as far as that expertise, you've got a lot of experience, you've got instincts about the market. A lot of what you have to do is try to figure out investor sentiment, investor psychology. So how do you do that?
It's become more and more difficult to see where that sentiment is because of ETFs and because of high frequency trading. So it's been more difficult to navigate where the fund flows are going and how clients are navigating and want to navigate the market for themselves. But really, it is quite simply, what are you looking to achieve and best execution to get to that achievement point.
There's a lot of trading going on every day. How much of that trading do you think is real investors putting the money to work, and how much of it is these computers, algorithms that are just, front-running clients? There's been a lot of talk with that in those books like Fast Boys and things like that. How much volume that you see on a daily basis is real?
I'd say, somewhere between 40 to 50%. And then outside of that, it depends on how you want to classify the ETF volume, because that can be considered as it is investors investing, but they're investing in a different product. But that does add to the volume in the underlyings. So I would say 50 to 60% is real investor. The rest would be high frequency trading.
Are we seeing a lot more retail participation? I know the retail orders from your firm go through to the institutional desk where they get handled. Are you seeing a larger order flow these days?
There's been a definite uptick in the retail order flow through this whole pandemic, I would say. You know, as you know too, we did see a big uptick in retail order flow around the whole legalization of marijuana. So I think when there seems to be an uptick around a crisis situation, maybe around a new sector where retail is, where retail wants to try to trade, try to be active, and that's where we've seen it.
Let's get to some pro tips for these retail investors that we're talking about. How do they filter the noise and have a proper plan and stick to it and not get drawn in or sucked into the wrong kinds of trades?
Well, I think it certainly comes down to what is the ultimate goal to achieve, and then how to get there. And I think it's very tough for people that they may overthink where they want to get to, and in doing so, typically sometimes you trade yourself out of a good situation into a bad one by over trading. I think my suggestion would be, you can make a good investment without having to trade a lot. And what I've seen over the last 25 years is people's time horizon on investment have become quite short, which means they're going to engage in more trading. And anytime you are engaging in more trading, you are susceptible to big swings in the market, maybe not buying at the right time, maybe buying at the high or selling at the low. But over trading is something that I would definitely suggest to keep it to a minimum.
And do you find that just by looking at the order flows and the size of the trades that you look at a certain stock and think, boy, these people are chasing this thing at these levels and they're going to get burned?
I think it's sometimes it's best to step back, reevaluate, and as I said, take some time to pause to determine whether this is the trade you want to do.
Are we at that stage of the market where you're seeing, a lot of people saying, I can't believe the market's recovered so much, things are still so bad out there. Obviously, there's been a lot of talk about retail investors getting into the market. They're bored, they're trying to make money. Are you seeing telltale signs, do you think, that kind of behavior is gripping the markets, or do you think it's overblown?
I certainly think there is some evidence of that in the markets, no doubt. I think everyone is very surprised at how quick the recovery has been, and I think there's a large, I would say, a large group of traders and investors that I speak to that do feel that we will be due for another pullback, maybe not as drastic as the initial one, but as we get deeper into seeing some of the earnings for the going out to the back half of this year and into next year, maybe things are ahead of itself. But definitely I would say there has been more speculative activity in the market over the last couple of months.
Brian, you hinted at the changes you've seen since you've been in the industry. You started in '97 on the Toronto Stock Exchange trading floor. So you could probably talk for hours about this, but how have things changed? What are the main changes you've seen from then to now in terms of trading?
I mean, the largest one is technology, and that has really changed, and it's changed forever, how we trade. And even year after year after year, the technology changes. It gets faster, and it gets even better and better. So that is hands down the biggest change. I think also more recently the creation of ETFs has changed the way that institutions trade, and probably does change the way that retail investors trade as well.
There's so much more information available now for retail investors. Have they almost caught up to professional traders, or will that never happen because you guys and gals will always have the better bells and whistles?
I think there's just more information sharing within the financial community that does help guide investments decisions that might not trickle down to that retail investor in that moment in time. It's sort of in that moment, second by second. So I do think that that sort of falls away, I think, once you leave the trading floor or the trading, the institutional community.